Welcome to our halftime report presentation. My name is Dan Cuddy, and in this presentation, I will be sharing some vital information with you regarding the markets in the first half of 2024. Please take a few moments to review these disclosures. I am here to help you better understand what happened in the stock market during the first half of 2024 and what may unfold in the months ahead. In this presentation, I am going to focus on 4 key areas. We will start by reviewing the first half of 2024. Next, we will take a look at potential market forces in the second half outlook. Following that, we will ask, where are we now? And finally, take a look at what's ahead for the second half of 2024. I will begin by reviewing how the stock market performed during the first half of 2024. Here is a snapshot of the S&P 500 index performance from January 1st, 2024 to May 1st, 2024. The S&P 500 notched a solid gain, supported by generally positive Q1 corporate earnings reports and news reports about how artificial intelligence was helping drive productivity gains. The first half was marked by 3 overriding themes. 1 was AI enthusiasm. 2 was inflation fears. And the third one were Fed signals. As monthly inflation reports gave mixed signals, the market looked for guidance from the Fed, which was balancing between how it planned to manage inflation while acknowledging economic activity may lead to a change in short-term rates. During the first half, you may have heard the phrase Goldilocks economy, which suggests activity was moving forward at a not too hot and not too cold pace. We use a chart of the S&P 500 Composite Index because it's generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analysts' predictions for the year ahead. This image shows several projections shared at the end of 2023. How do these predictions compare to reality so far? The S&P 500 closed at 5,277.51 on May 31st, 2024. The S&P 500 closed at 4,770 on December 31st, 2023. Through the first 5 months of 2024, stock prices have exceeded what our 6 leading Wall Street firms had predicted. Even the most optimistic forecasts in this table represents an increase of just under 7% for 2024. The outlook reflected expectations that the economy would likely run out of steam or inflation would reignite, which may have resulted in higher short-term interest rates. Predicting where the S&P 500 will be by the end of the year is always challenging, especially in 2024, given the uncertainties of inflation, global economic growth, and central bank moves around interest rates. It is worth repeating that the S&P 500 Composite Index is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. In the following slides, I will discuss the factors that may impact stocks in the second half of the year. To create some context about where the economy may go in the second half of the year, let's start by looking back a few years so you can get a better perspective on how quickly outlooks can change. We picked January 2022 as a reference point since it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicators suggest, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve's monetary policy remained accommodative, and interest rates had not yet begun their climb from their historic lows. On virtually every important indicator, from inflation and monetary policy to credit demand availability to energy cost, it was flashing positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuation, and geopolitical risk. There were no negative indicators. However, these conditions would soon reverse. By January of 2024, just 24 months later, the outlook for the coming 3 to 6 months changed from optimistic to guarded. First, despite interest rate hikes to historic levels during the first half of 2023, by the second half of the year, the Fed had started to slow down the pace of that tightening. As you can see, 17 of the indicators were neutral at the start of the year, while 3 slipped to red: equity market valuations, international economic outlook, and geopolitical risk. Now, let's see where we are today. Can you see the difference? Now, roughly 1/3 of economic and financial indicators are positive, with only 2 negative: valuation outlook and geopolitical risk. Q1 earnings season helped boost the corporate profit outlook, and notably, inflation, labor, and credit availability are among the indicators now in the green. Consumer spending and consumer sentiment, along with housing, one of the most stubborn areas of inflation, have also swung to positive outlooks. This chart shows the relationship between changes in S&P 500 performance and the 12-month forward earnings per share. As you can see, the 2 lines have generally moved in the same direction over the past decade, because the stock market's discounting mechanism, reflecting what investors believe the economy will look like 6 to 9 months in the future, stock prices can, at times, change more quickly than earnings growth. Here are a couple of reminders. First, past performance does not guarantee future results. Over the next 10 years, the correlation between stock prices and corporate profits may look different. Second, individuals cannot invest directly in an index. And third, the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. At the highest level, the Federal Reserve has three functions. One, to provide an effective payment system for the U.S. Two, to regulate banking operations. And three, to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rate. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. The charts we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see in the charts to the left, there was an uptick in year-over-year inflation numbers in Q1 2024, which is one reason why the Fed is being cautious about changing course with interest rates. That Q1 increase was followed by a modest decline in April, but the consumer price index still remains above the Fed's target 2% inflation rate. Expect the Fed's decision on monetary policy to continue to influence the financial markets throughout the second half of the year. The labor market continues to demonstrate its resilience despite questions about the economy. This vitality has provided an important support to the markets since having a job is foundational to consumer spending, which helps drive economic growth. This strength may be best illustrated by two labor market measures: the unemployment rate and current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring by private sector employers. Even in the face of this robust hiring, the percentage of companies unable to fill open positions remain quite elevated despite falling off somewhat over the past 12 months. By these two historical measures, the labor market appears healthy. The University of Michigan Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of the gross domestic product. As the chart indicates, consumer confidence has continued its recovery from historic lows in June of 2022. The chart shows that sentiment has been on a general upswing since 2022. Artificial intelligence has been a market buzzword for the past couple of years. And to keep investors updated, Standard & Poor's 500 companies are providing updates as part of their quarterly conference call with investors. As you can see in the chart, in Q4 2023, AI was mentioned on earnings calls 179 times, as investors want to hear from companies about their plans to use the newest technology. Now I will examine the present before diving into what the future may hold. Take a moment to consider the variables that may weigh heaviest on market performance. We believe the factors that led to the first half's market performance may remain critical to how the market may behave in the second half. The first factor is inflation. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly the Federal Reserve, worry that inflation may prove to be sticky at these elevated levels. If inflation remains where it is presently, then it may influence the Fed's decision on short-term rates. Recession is still a possibility as the economy has showed signs of slowing. However, the U.S. economy has remained resilient, raising hopes for a soft landing. And if the economy slows too much, the Fed has stated it stands ready to cut rates to spur economic activity. If artificial intelligence continues to be a driver of stock market gains, particularly when companies discuss AI adoption into their operations, greater efficiency, focused capital spending, and continued positive consumer sentiment are factors that would push companies to explore AI opportunities. Of course, no one can predict what will happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. And finally, we will go over potential forecasts for the second half of the year. Economic growth may be an integral variable in how the markets perform in the coming quarters. To gain better insight into how economists think the economy will perform, we took a look at the May 2024 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Let's look specifically at the consensus forecast for three key economic factors that may drive much of the market's perception about the state of the economy: GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 2024 is that gross domestic product growth is expected to be between 1.5 and 2.4% in 2025. Meanwhile, these professionals are projecting that the unemployment rate remains low at between 3.7% and 4.25% in 2025. And they expect inflation, as measured by the core personal consumption expenditures, to be between 2.0% and 2.4%. Remember, forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecast. Some market strategists look at the bottom-up earnings per share to help set their price targets for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the bottom-up EPS and the price of the S&P 500. A word of caution that this type of analysis shouldn't be seen as a perfect predictor of stock price performance. In this chart, notice how stock market prices have been trending flat to higher, while corporate earnings are more mixed. When evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means that it's always looking forward. Put another way, the stock market's price today represents all available information about current and future events. How far forward is the stock market looking? Most would agree it's discounting activity 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain, and only time will tell. Here are a few things to keep in mind. First, past performance does not guarantee future results. Second, individuals cannot invest directly in an index. Third, the return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. Considering the importance of corporate earnings to stock valuations, the big question for investors is, what can we expect for future corporate earnings? Market analysts expect all 11 market sectors to show earnings growth overall, but they anticipate earnings slowing a bit in 2025. If you take a look at the chart, you'll notice the earnings for 6 out of the 11 industry sectors of the S&P 500 are expected to grow compared with today. Near the center of this chart is the overall earnings growth projection for all S&P 500 companies, which is estimated to be 4.2%. Some sectors are expected to do better, while others are projected to lag. Future progress on inflation may be a bit more difficult. One aspect of inflation in particular focus for the Fed, as well as market analysts and economists, is what is called sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater rigidity or stickiness with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while 12-month CPI is the gray line. Sticky inflation includes many service-based categories, including medical services, education, and personal care services, as well as most of the housing categories. Federal Chair Jerome Powell has often referred to stickiness and service-related inflation as one reason for remaining vigilant in the Fed's fight to lower inflation. As you can see in the chart, while the Atlanta Fed's measure of sticky inflation has been stubborn, it has moderated over the past year or so. Needless to say, the Fed has much to consider as it evaluates monetary policy. Among the biggest questions investors have heading into the second half of the year are, will the Fed adjust interest rates before the end of the year? And does the Fed see inflation as a threat? And if so, in what areas of the economy? The next 4 meetings of the Federal Reserve Open Market Committee, or FOMC, are likely to answer some of these questions and provide additional clarity for investors. Typically, if the Fed is going to make an adjustment to interest rates, it will announce the change following their 2-day meetings. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, existing bond prices go down. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean you have to abandon a fixed income approach. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need. However, keep in mind that there is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if security prices decline. Tuning out headline noise when managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals like a company's earnings or economic data. I've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set for ourselves. After a disappointing 2022, frustrations were high, but since late 2023, stock prices have been trending higher. This chart shows an analysis of bull and bear markets during the period from May 26, 1970 to March 28, 2024. Here we see that the average bull market lasts nearly 76 months. On the other hand, the average bear market has run a little over 15 months. As we can see above, the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over the long term. Remember, investing involves risks, and investment decisions should be based on your own goals, time horizon, and tolerance for risk. The S&P 500 is an unmanaged index that is generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results, and individuals cannot invest directly in an index. The next point I'd like to convey is a cautionary one on the temptation of getting caught up in exciting new investment themes. This chart illustrates such exuberance happens from time to time. As you can see, faddish themes have occurred fairly frequently since the 1970s, when gold rallied higher only to trend lower. These trends can develop in broader markets like Japan and Asia, as in the late 80s and 90s, or they can form in certain asset sectors such as internet or biotech companies. The enthusiasm for artificial intelligence, or AI, started in late 2022 and continues to grow today. What I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by fads. Does AI offer the potential of meaning capital growth for investors in the years ahead? It may very well, but there are ways to incorporate AI into an investment strategy that takes into consideration your goals, time horizon, and risk tolerance. Keep in mind that some of the investing fads you're looking at can be considered sectors of the stock market. And because of their narrow focus, a sector investing strategy tends to be more volatile than an investment strategy that is diversified across many sectors and companies. Sector investing is also subject to additional risks associated with its particular industry. Sector investing can be adversely affected by political, regulatory, market, or economic developments. Thank you for taking the time to watch this presentation. As you can tell, I'm passionate about helping our clients understand the markets. For more information and timely updates, please follow us on social media and contact us at any time. Thank you again, and until next time, take care.